Hey everyone, welcome back to Corporate Decoder, where we dig into the nitty-gritty of company filings, and today we've got something cooked up that has got a bit of a secret ingredient and a whole lot of borrowing. If you appreciate getting straight insights from corporate documents, make sure you are subscribed. We also have a Discord, a community linked in the description below, where we break down these filings together. Alright, so what we are looking at today is a Form 8K filed by Apollo Debt Solutions BDC. Now an 8K is a bit like a special announcement, a heads up to investors that something important has just happened. This particular filing is all about a new loan agreement and how it will work with a related company. The core of this announcement revolves around a new credit facility. Think of it like a big box of money that a company can borrow from. This new facility is called the Warbler Funding Credit Facility, named after a new subsidiary they set up called Warbler Funding LLC. This subsidiary is like a brand new wing of Apollo Debt Solutions BDC, and this new loan is a pretty significant amount. So what is this new credit facility all about? Well, Warbler Funding is going to be the borrower and Apollo Debt Solutions BDC. The parent company is providing certain assets to back this loan. The initial amount they can borrow is up to $500 million. Yes, you heard that right. $500 million. And what is really interesting is that this amount can actually be increased up to $650 million if they want to, thanks to something called an accordion provision. That is like a built-in option to get even more money later. This money isn't here just sitting there. The plan is to use the borrowed funds to help Warbler Funding buy and generate new investment. Some of these investments might even be sold from Apollo Debt Solutions BDC to Warbler Funding. The parent company says that no profit or loss will be made on these internal transfers, which makes sense as it is all within the same sort of business umbrella. Importantly, Apollo Debt Solutions BDC will still have an ownership stake in Warbler Funding, meaning they will still benefit from the success of these new assets. Now let's talk about the repayment structure. They can draw and redraw on this loan for up to 3 years. After that, the loan is set to mature 5 years after the initial agreement date. Think of it this way: for the first 3 years, they have flexibility to manage their borrowing. After that, things become more structured, and by the end of 5 years, the whole amount needs to be paid back. Any money that Warbler Funding makes from its investments during this time, like interest or dividends, will first go towards paying loan fees and interest, and then any remaining cash can be given back to the parent company, Apollo Debt Solutions BDC, under certain conditions. The interest rate on this loan is also a significant detail. It will be based on different benchmark rates depending on the currency borrowed, like SOFR or Euribor. On top of that benchmark rate, there is an added margin of 1.90%. This means the actual interest rate will fluctuate with market conditions, but will always be at least that 1.90% higher than the chosen benchmark. What makes this loan arrangement even more serious is how it is secured. Apollo Debt Solutions BDC is essentially pledging the assets within Warbler Funding as collateral. This means if Warbler Funding can't repay the loan, the lenders have a first claim on all those assets. The filing explicitly states that these pledged assets will not be available to cover the debts of Apollo Debt Solutions BDC itself. This is a pretty standard way to structure secured lending. It protects the lenders by having clear recourse if things go wrong, but it also means those specific assets are ring-fenced and cannot be used for other purposes by the parent company. Now, for those familiar with investment companies, this next point is crucial. The loans taken out by Warbler Funding are counted as borrowings for Apollo Debt Solutions BDC when it comes to meeting the rules under the Investment Company Act of 1940. This act has specific requirements about how much capital companies like this need to hold relative to their debt, often referred to as asset coverage requirements. So, while this is a loan to a subsidiary, it directly impacts the parent company S regulatory compliance. These agreements, the Loan and Security Agreement and the Loan Sale Agreement, are the legal documents that lay out all these terms. They are filed as exhibits with this report. While we summarize the key points, the actual contracts contain all the nitty-gritty details and legal protections for both sides. So, what is the big picture here? Apollo Debt Solutions BDC is essentially setting up a new financial structure, using a subsidiary to access significant debt financing. This allows them to potentially grow their investment portfolio and their overall business. The large loan amount, the flexibility to increase it, and the secured nature of the facility all point to a strategy of aggressive growth and leverage. From a Warren Buffett perspective, we want to see how this leverage impacts the overall health and management of the company. On the surface, securing $500 million with the option for more is a bold move that signals confidence in their ability to deploy capital effectively and generate returns. However, leverage is a double-edged sword. While it can amplify gains, it also magnifies losses and increases financial risk. The fact that this loan is secured by the assets of the subsidiary means that if Warbler funding struggles, those assets are gone. The key risk here is repayment. Can Warbler funding acquire and manage assets that generate enough income to service this large debt? Not just the interest, but the principal repayment when it is due. The company's ability to weather economic downturns and fluctuations in the market will be critical. The success of this strategy hinges on the quality of the investments Warbler funding will be making, and Apollo Debt Solutions BDC's overall management of this new financial architecture. In conclusion, this filing marks a significant step in Apollo Debt Solutions' BDC's strategy to expand its lending and investment operations through its new subsidiary Warbler Funding. The $500 million credit facility with room to grow represents a substantial use of leverage. Investors will need to watch closely how this debt is managed and how effectively the capital is deployed to generate returns that can cover the cost of borrowing and ultimately benefit the parent company and its shareholders. The success of this bold move will depend on disciplined execution and favorable market conditions. Alright, that is our breakdown of this 8K filing. What is your take on this new credit facility and what it signals for Apollo Debt Solutions BDC? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't you forget to check out the Discord in the description. Thanks for watching. See you next time.